Good afternoon. This is Steve Wilkes at the Wagner Law Group in our San Francisco office. Welcome to today's webinar on controlled groups. We're going to discuss the rules for qualified retirement plans. Thank you very much for joining us. Glad you're here. Our agenda for today, we're going to cover a little bit of background and the importance of these rules. In other words, why do we care about them? What does it matter to us? Whether you're a plan sponsor in the audience or an advisor to an underlying plan, you'll have some needs and interests to deal with these questions, we think. I'll talk about the types of control groups and some of the basic rules, and we'll itemize and point out for you the various qualification requirements that are impacted. In other words, the failure to properly identify and treat a controlled group situation where one or more plans are maintained within the controlled group. If they're not treated properly in the context of a control group, you have a host of qualification issues, discrimination, vesting, all those things that can be jeopardized and provide some negative results that we don't want to see. I'm also going to touch a little bit on some of the implications just for your awareness under Title IV, the Pension Benefit Guarantee Corporation rules, for those of you that might be dealing with funded defined benefit plans. A little bit about the concept of joint and survivor liability, where you have one or more employers in this family of companies, perhaps sharing liabilities for failure to satisfy the rules. A little bit about the private fund context as well. And then I'll close out by reminding everyone that even though we're talking today primarily in the context of plan qualification and qualified retirement plans, the concept of these controlled group rules also has significant play in the world of employee welfare plans, health and welfare, especially with Obamacare and all the complicated rules that apply, and also non-qualified deferred compensation as well, 409A deferrals and scenarios. I want to remind everyone that even though we'll be using controlled groups as the primary definition and talking about blocks of businesses that are, basically part of the same family, that these concepts of controlled groups and the implications also roll over to employee leasing scenarios and affiliated service groups. And I'll try to mention those a little bit as well. So let's start off. Why are we talking about this today? Well, the control group rules and the affiliated service group rules really provide the framework for determining when two or more employers need to be grouped together, aggregated, treated as one employer for the purposes of the underlying benefit plans that they're maintaining. And again, this could be implicated in terms of discrimination testing and eligibility and so on. And this also folds over to the employee leasing and affiliated service world. So the rules are very important. I think the biggest downside of failure to properly handle the control group scenario, and there could be some reporting issues in terms of 5500s and things like this, and not to minimize the importance of that, but it also has potential qualification ramifications because there's a host of discrimination and other testing rules that apply, and if you don't have them properly analyzed in the context of the controlled group, the end result is that you may not have a qualified plan or plans. We all know where that could lead. We see this pretty commonly in our practice here at the Wagner Law Group. It's a pretty common question. Plan sponsors will ask us about one or more of the plans that are maintained in their family of businesses, and we're not quite sure how to treat them, if they should be separate or combined, if they're disparate, if they can operate on different platforms or not. Similarly, advisors to underlying plan sponsors, because they tend to be the point person and handle a lot of key questions. Advisors want to know, need to know, like to know in order to help their clients with these multiple plan scenarios and multiple corporation scenarios. A lot of questions come up there. And we see it as it's a very common question. It's frequently misunderstood. It comes up a lot in the context of just general merger and acquisition activity. So we wanted to point out some of the ground rules for you today in order to alert you and enable you to perhaps better spot the issues. I think I already mentioned that, the purpose of these rules is to determine when you have two or more corporations or traded businesses and they need to be treated as one. Controlled groups of corporations can break out in different ways. They're really defined by reference to the consolidation rules in the Internal Revenue Code with some variations. These are very mechanical, technical tests. They can be pretty complicated, and sometimes you don't need the actual control of a business. It relates more to various attributes of ownership. But you can see three different categories of control. We see three different categories of control groups anyway, typically, where the groups are going to be treated as one employer. You have your parent-subsidiary situation, brother-sister groups, and it could be a combination group. We have a parent-sub and a brother-sister group all together. So parent-subsidiary groups, that's going to exist. A parent subgroup will exist when we have one or more chains of organizations are connected by ownership with a common parent, and there's an 80% controlling interest in each organization, excluding the parent. And the parent, owns at least 80% of one other organization. So, for example, parent owns 100% of the stock of subsidiary A. Subsidiary A owns 80% of the stock of subsidiary B, but only 50% of the stock of subsidiary C. So in this scenario, the parent and subsidiary A and B are part of a control group. You have that 80% overlap. But the third level, subsidiary C, will be excluded because it didn't clear that 80% threshold. I want to point out also that when we look at the corporate ownership, sometimes we're looking at voting power, sometimes we're looking at stock value. Either one could be sufficient. We also, are going to be applying this standard. We're going to be looking at partnerships, sole proprietorships, solo businesses, JVs, trusts, and estates. They can be part of a parent-subsidiary group as well. And there's some special rules that might apply. Like, for example, in a partnership scenario, you're looking at 80% interest in capital profits. On the brother-sister side, it's a little more complicated. A brother-sister group is going to exist for purposes of the control group tests, the code, if a group of two or more corporations where 5 or fewer common owners, and they could be individuals or trusts or estates, 5 or fewer common owners directly or indirectly own a controlling interest, which generally means 80% or more of the stock in each corporation. And they have effective control, which generally means more than 50% of the stock of each corporation. These rules can be, and again, the entities here could be partnerships and individuals, trusts, as well as corporations. Family attribution rules might apply. So stock owned by a spouse, for example, or a parent or a child might be attributed to an individual. I think all these rules are, they can be fairly complicated and a little bit daunting. A lot of times we're asked to come in and analyze the situation and just provide an opinion so that the plan sponsor, the advisors, the consultants can all move forward how to handle their business. There are some special things to remember in terms of foreign ownership as well. Brother-sister trades or businesses can be aggregated by ownership by a foreign parent, even though the foreign parent is not in the group that files a consolidated tax return in the United States. So in this situation, even though the foreign parent is technically part of a control group, foreign employees don't necessarily need to be covered under the U.S. plan because the code allows non-resident aliens with no income to be excluded. But a lot of special rules there. And there are some other special rules, some other special attribution rules that relating to the voting stock or stock value or capital or profits in the partnership scenario. And there are some rules that apply to all scenarios. There's some other rules that apply to brother-sister groups only. I'm not going to go into those today other than to say that you need to be aware, when you're going through these scenarios, whether you're looking at a parent-subsidiary chain, at a brother-sister chain, you're looking for the presence of trusts and estates as compared to corporations. You might be looking for the presence of options as compared to actual stock ownership. And for the attribution rules, you're looking for spouses, children, parents. And you have to take all these things into account. There are also some interests that are excluded when you're measuring and assessing a control group scenario. Treasury stock, You look beyond non-voting stock that might be limited to dividends. You look beyond interests that are owned by trusts of deferred comp plans. You look beyond as well. And finally, as I mentioned before, you have, in addition to the parent, subsidiary, brother, sister, you have combined groups, and that's a separate analysis, and that's where you've got a parent, sub, and a brother, sister group. They're all sort of combined together into one mix, and that takes an analysis of its own. So it can be pretty complicated stuff, but it's very important, and something that you should be paying attention to. Now, many of you listening have heard about affiliated service groups. They're really part of the same family, or part of the same narrative when we talk about control groups for purposes of dealing with qualified retirement plans. The Internal Revenue Code treats certain service businesses that jointly provide services to third parties as one employer for some purposes. And the reason they put these rules in place was to eliminate, the end run, the creation of an artificial business for the purpose of excluding, non-highly compensated employees from a plan, by trying to move employees or control, if you will, out to separate but affiliated entities. Affiliated service groups can be pretty complicated, and it requires an in-depth analysis of a lot of different relationships between the service organizations. The IRS has some good materials out on this, by the way, in their publications with all kinds of examples and flow charts. But the thing is, an affiliated service group is going to be comprised of a designated first service organization. That's where some of you have heard of FSOs. Plus, so this FSO will be combined with either an A organization, that's a service organization that's a shareholder or partner in the first one, and it performs services for the first service organization, and it's regularly associated with the FSO and performing services for third parties. Or it could be a B organization. This is where a B organization is one where a significant portion of the business of the B org is the performance of services for the FSO or the A org or both. They have a historically demonstrated working relationship. And there's some measurements. You're looking for 10% interests in the B org that are held by individuals who are highly compensated employees. Anyway, if I've confused you, sorry about that. It can be pretty daunting. I just want you to be aware that when you have these service-related entities, it looks like maybe they're not part of a control group. We still need to look at them and see if they need to be aggregated, because they get captured, if you will, in this definition. First service organizations, have to be either a corporation, a partnership, or some organization that's engaged in the performance of services. Capital must not be a material income-producing factor for the organization. These are service orgs. And generally, capital will be deemed to be a material income-producing factor if a substantial portion of the gross income is attributable to investments, in items like plant, inventory, fixed furnishings, things like that. So an organization, by the way, the following organization will pretty much automatically be deemed to be FSOs. You need to really be thinking about affiliated service rules in these scenarios. Health practices, where doctors, dentists, optometrists, nurses, are kind of banded together. Law, engineering, the services, architecture, accounting, consulting firms, a lot of times insurance. And sometimes you have to be also looking in the affiliated service group world for groups that are made up of what we call the management groups. And these are groups where an organization where the principal business is performing, on a regular basis, management functions for one organization or another that's related to the organization. So again, these are just examples of services management where you need to be thinking about aggregating and seeing if there's a tie-in under these affiliated rules, because if they are, you have a lot of tests to run. Let me give you just very quickly. I'm going to go through these, but under the affiliated service rules, some of the lists of tests that you would have to consider, it's really daunting. You have to look at coverage, discrimination, vesting, annual addition, the annual addition limit, the 415 limits, compensation, participation, minimum vesting, top-heavy, and then there's also a lot of rules that you need to think about for both the control group and the affiliated service group scenario. There's special rules under group term life, and health coverage, and cafeteria plans, and fringe benefits, COBRA. So it really triggers quite a bit. The implications are far-reaching when you end up with an affiliated service group or control group. Let me come back though. Let me reel it back in and talk about plan qualification a little bit. When the sponsor of a plan is a member of a control group, all the employers in that group are basically going to be treated as a single employer to see if that plan satisfies the myriad of requirements under the Internal Revenue Code, the qualification rules. And therefore, for every plan that's sponsored by a control group member, you have to be thinking about, as I said before, discrimination, compensation, vesting, and a host of other requirements. Let's talk about non-discrimination first, just to kind of give you an example. So as you know, the code says that you can't discriminate. You have to cover and provide benefits to a minimum percentage or a certain number of the non-highly compensated within a group. And the non-highly compensated are those that are not highly compensated. And the highly compensated, are 5% owners or people whose comp in the previous year. I think for this year, in 2015, we would say compensation for the prior year was at least $120,000, or maybe in certain scenarios you're looking at the top 20%. So you have to carve out and make sure that these discrimination standards are upheld. A qualified plan can't base benefits on compensation in excess of certain limits. Now, for this year, 2015, it's $265,000. And compensation from all members of the control group or the affiliated service group is going to be aggregated and looked at in this light. You have minimum participation in the defined benefit world anyway. A DB, a qualified plan, must provide benefits to the lesser of 50 employees or 40% or more of all the employees. So if you have to look at that 50 or that 40% in the context of a large group of employees if you're in a control group scenario. And sometimes this is one, even though 401ks are very so popular these days, we still deal with a lot of defined benefit plans at our firm. And I will say that this 50% thing tends to be overlooked and forgotten quite often, and it could be a real challenge. It can present a real challenge. Sometimes you get you're freezing a plan, or you're implementing a reduction in force, you're acquiring a new plan, you're distributing lump sum benefits in a frozen plan. You really need to be aware of this participation rule. You got the same thing also. It applies vesting and eligibility, service and credit. A qualified plan, has to credit a participant with years of service for any member of the control group, not just the actual employer, or for anyone who's in a commonly controlled entity, or any member of the affiliated service group. So that can become pretty complicated. You have 415 limits, as everyone knows, in benefits and contributions maintained by employers must be aggregated to determine the maximum amount of comp or maximum contribution and benefit that can be taken into account for 415. So this year, 2015, you have a dollar limit, $53,000, or it's the lesser of $53,000 or 100% of your compensation. In the defined benefit plan, it's the lesser of $210,000 or 100% of your average comp for 3 years. You need to, people need to stay in line with these rules. We have some special rules for top-heavy. As you know, top-heavy plans provide that disproportionate benefits to certain employees is not allowed. And you have to look at this in the context, again, of a control group and identify key employees. You have minimum funding, defined benefits, target benefits, money purchase plans. There's going to be minimum funding requirements. And here's an area which is a little more complicated, because if you're in a control group and one of your fellow group members fails to satisfy the funding requirement, let's assume that companies A, B, and C are all part of a control group, but operating pretty independently. They're not really fully aware of the overlapping pension law responsibilities. If your colleague in Company C fails to meet its obligations to fund a pension plan or a money purchase plan, and if you don't make it on time, or you don't get a waiver, there's an excise tax due, and the law says that this is going to be joint and several liability, not only for the funding but for the excise tax. Well, that's quite a surprise. So we see that in the context of larger companies, sometimes a lot in public company scenarios and in larger, more complicated corporate structures, and it can be quite daunting. There's also some special rules that relate to the SEPs and simple IRA plans that apply in terms of this context. I want to remind everyone that where you have income that's not subject to tax in the U.S., a non-U.S. control group member, a plan might provide that foreign income not subject to U.S. tax is excluded from compensation. And this is something that needs to be handled, properly within the control group context. So, compensation generally includes all income from all sources, regardless of whether it's excluded, under a tax treaty or something. But if there's non-U.S. control group members, there might be some special nuances in that rule they need to pay attention to. Finally, this is something that we see a lot. It's a challenge and also a planning opportunity, because sometimes we use these separate line of business. We just call them SLOB or QSLOB. That's the way they're referred to in the retirement world. There's an opportunity to maybe do some planning, but also a trap to be caught by if you're not careful. But basically, a control group of separate plans, it might elect to test its plans separately for certain purposes, including minimum coverage. And you can do this if you can demonstrate you're a qualified separate line of business. Now, this is pretty daunting. The law is pretty complicated. There are a lot of private letter rulings. It's very fact-intensive. But to determine whether or not you can take advantage of this, an employer would have to allocate its physical assets, its properties, and its services by line of business. We'd have to demonstrate that these lines of business are operated and organized and constituted as separate units, separate workforce, separate management, separate financial nexus, and they have to satisfy, certain safe harbors. There's a statutory safe harbor. There's some administrative safe harbors. So there's a lot of hurdles. Every qualified separate line of business has to have at least 50 employees. But if you can get over these hurdles, you can maybe differentiate your benefit program. Sometimes it makes sense for business reasons to have a different benefit structure for different groups, but it's a high hurdle to clear the discrimination rules. So this can be an opportunity. By the way, people sometimes ask, well, when do we figure out if we're a control group? What point in the year do we look at it? And I think in general, you look at control group, you make that test. You look at it on the actual testing date. But there's some transition rules for mergers and acquisitions that can be applied, and some other special transition rules to keep track of. Let me just mention a little bit on Title IV of the Pension Benefit Guarantee Corp. I mentioned that earlier. Here the PBGC is quite clear that when they're talking about an employer, they're talking about all persons, all entities that are under common control with the contributing sponsor of the plan. And there are some regulations here as well. And again, that's something that can become a technical analysis and can be fairly nuanced and difficult, but something to keep your mind on. Also, just related to the PBGC, to finish out that thought, just the concept of joint several liability. When you have control group status, you're going to have joint and several liability. You're responsible for yourself and your partners or your colleagues or your fellow corporate entities, if you will. Insurance premiums under the PBGC, you're on the hook for your colleagues' termination liabilities, in the event of a plan termination. You're just generally liable for whatever your colleague would be liable for as a single employer plan. And certain penalties, failure to notify the PBGC of certain events triggers some penalties. There's a liability, a complete or partial withdrawal from a multi-employer plan. That's if you're basically in a union or collectively bargained plan. You'd be liable if someone pulls out, it's not funded properly. someone leaves the table too early, you get stuck with a little bit of the dinner check. Is kind of the roughest analogy I could come up with on that one. So there's a lot to think about there. And we see this a lot, in corporate transactions, the idea of having joint and several liability when you're part of a selling group or you're coming into a group where there are multiple parties on either side of the equation. You have to really be aware of each other's joint and several liabilities in the pension plan scenario. We also get a lot of these questions on, involving private equity funds, companies that are, funds that are out there buying businesses. Typically, these private investment funds were not considered a part of the seller's controlled group because they weren't considered a trade or a business. And the Supreme Court has said that a trade or a business for tax purposes is when one is engaged in an activity for the primary purpose of income and profit, and does it on a regular basis with continuity and regularity. So I think the general trend over the years in rulings from the judicial system and the IRS have kind of supported the notion that a passive investment, such as investing in a private equity fund, is not a trade or business, and therefore you're not part of a control group. That's been litigated. There's been litigation on it, and as most people listening might remember, a couple of years ago, it really broke out into the limelight. There was a case called Sun Capital Partners. It was, in that case, a multi-employer fund. It sued two private equity funds, saying that they were under common control with and liable for the withdrawal liability of a bankrupt company that they owned and which had ceased contributing to the plan. So in this case, they decided that at least one of those funds was found not to be a passive investor, but actually in the trade or business of managing the company's activities, and it was quite a surprise for everybody. So that's something to think about for as well. Just when there's an investment partner, maybe deeming itself as a passive investor in the business as compared to a fellow operator or a fellow control group member, where this control group liability can come through. Let me finish up and just talk for a minute or two on some of these other applications to round out your awareness. As I said before, these control group rules and concepts also apply to health and welfare. You're going to see them in the context of COBRA obligations when people are potentially liable for COBRA penalties or COBRA compliance, or whether or not you're eligible for an exemption as a small employer, making COBRA coverage available. It could be aggregated. You're going to see it in the non-discrimination testing rules, for self-insured group health. In fact, they say right in the Internal Revenue, they reference the fact that the control group rules are going to be applicable for non-discrimination testing here, something to be aware of, people forget about a little bit. You can see it for cafeteria plan compliance, when you figure out which employees can participate in your Section 125 plan, who's a single employer for purposes of testing. We're going to see it with certain fringe benefit rules. The employer mandate under the Affordable Care Act, under the proposed regs anyway. The control group rules apply for when you count the number of full-time and full-time equivalent employees to determine whether an employer is a large employer subject to the employer mandate or not. And that could be pretty far-reaching right there. And finally, in the deferred compensation world, severance plans, deferred comp arrangements, you're going to see the control group rules come into play for purposes of first of all, when you're just defining the service recipient, the person or the entity for which services are performed in the deferred comp arrangement takes into account the control group rules. When you determine when a separation from service occurs, it's supposed to be based on the date that the employee stops performing services for the employer and its affiliates. And who's an affiliate? Who's a relevant affiliate? That's going to be determined under the 409 Cap A deferral rules, and they in turn apply the controlled group rules. But here though they're looking at 50%, not 80% common ownership. So there's some nuances there. It might aggregate deferred comp arrangements, might be aggregated in certain instances. So it has a lot of play there as well. So final thoughts before we sign off. A couple of things. Number one, these rules can be pretty complicated. They're manageable, but they can be pretty complicated. Parent, sister, parent, subsidiary, I'm sorry, brother, sister, management groups, affiliated service groups, a lot of different scenarios in which you might end up treating a group of what looks like potentially disparate or unrelated businesses as combining for various benefit plan purposes as well as healthcare purposes and deferred comp purposes. The most important consequence or the most potentially devastating one would be the failure to satisfy some of the qualification rules because of the way testing applies. So I hope this is helpful to you. If you're a plan sponsor and you're working with these issues, or you're an advisor and you have underlying clients that are maybe wrestling with these things or involved in merger and acquisition activity, we're glad to answer your questions. It'd be helpful anytime. Just send me an email, or any of my colleagues at the Wagner Law Group. We're glad to respond to you. So thank you very much for joining us today. I hope you're finishing up a good summer as we round the horn here into September. We'll be sending out information on my next webinar, which will be on September 24th. 4 p.m. Eastern, 1 o'clock Pacific. Thank you very much and have a good day.